Today, just like we stopped in our last class, a lot of continue from where we stopped in our last class. We were discussing filing of tax returns by petroleum companies. In the last class with you, I told you that there are two types of filing. The first one is estimated filing. The second one is actual filing. For the estimated filing, I remember I told you that the company must file on or before February, end of February of every year. Meanwhile, for actual filing, company must file within 5 months of the year. And I told you this relates to the transaction of the previous accounting year. We went back to the estimated filing. Under the estimated filing, I said after the taxpayer had filed its estimates, which was February every year for the current year, the taxpayer must also ensure that this estimate that you have filed, I said, let us assume the guy filed an estimate of $100 million. This estimate of $100 million that you filed will be divided by 12. Let's say you filed 120. You divide by 12 months. And the first estimate is due for payment 1 month after the month of filing. So therefore, I am saying first installment is due for payment on or before 31st March, let's say, of 2025. Second installment on or before April 30, 2026. Sorry, 2025 rather. Third installment, 31st May, 2025. Fourth installment, 30th June, 2025. Fifth installment to 12 installments. 12 installments will be February, 28th February, 2026. So by implication, that means all these estimates you must pay tax on them. You must pay tax on your estimates. So at the end of the 12th installment, there's every possibility that the taxpayer has now known the actual tax liability for this 2025. That is, who is that? Mention your mind, please. That is, in 2026 now, you have now all your transaction has come in, you have audited your financial statements, you now know exact amount of tax that you're going to pay. You remember what we did was to divide 120 by 12 to say that is the estimate that the guy will be paying. So on a monthly basis, this guy pays 10 million naira, $10 million. So at the end of the 12th installment, the guy would have paid $120 million. But actual returns will come in. Now, for the actual returns, you have audited your financial statements. And after you have audited your financial statements, you have now known that you're supposed to pay from your audited financial statement and your tax computation. You now know that you're supposed to pay 145 million. So this 145 million and the 120 million you already paid, the difference between the two will be called the 13th installment, which of course is the same thing as final installments, which is the same thing as final installments. So if that is the case, we are going to be looking at the illustration you have in your study pack to quickly demonstrate this. Open your study pack where you have filing of tax return. Filing of tax return.
Hello, sir.
Yes.
Hello, sir.
Yes, I'm with you.
Please, can you come again with this filing of the allowable? I didn't really get
Don't worry.
about
Let's do this illustration.
After that gets it. After that get my get it.
Oh, I get it. All right. You get it. So let's look at Mirror PLC, Mirror Petroleum Development Company. Have you seen this? Have you seen the question?
Yes.
Okay.
what
Read
page?
for us.
Yes, sir.
Read for us.
Yes, sir. Oh, okay. Mirror Petroleum Development Company Limited submitted its first estimate to FIR for 2023 on 27th February 2023 with tax payable.
Hold on.
Okay.
First estimate. When did they submit it?
Was submitted on 27th February 2023.
What does that mean? That means the guy had met with the conditions that you must submit your estimate on or before 28th of every year, February 28th every year. So that means the guy has completed, did not go far of the law with regards to this. So he has now submitted his first estimate. Now the estimate that he submitted, how much was he submit? How much did he submit?
$60 million.
$60 million. Just like I told you, what do you do to these estimates? You divide by 12 months. So that means for every month, the guy will be paying 5 million. So I come. I'll say months, due dates, and amount due. The first one, this will be due for payment when? 31st March 23. Abi, how much? 5 million. Actually, this value relates to January payments, but which is going to be paid in what? March. Because after you have submitted your estimate in February, 1 month after you must pay. So we continue. In February 2023, which the due date is 30th April 23, 5 million. Next one, March. The due date for that will be 31st May 2023, 5 million. April, 30th June 23, 5 million. They now told us, so when we move, they said in July, a revised estimate was sent to the Federal Inland Revenue Service, which amounted to $84 million. $84 million. That means this value is the second estimate. The revised estimate now, which is 84 million, must now be incorporated into our payments. That means this guy will now continue to pay 84 million. Okay? The guy will continue to pay 84 million. How do I mean? Let's go. Now, before now, this guy was supposed to be paying 60 million, which is, when we divide it by 12, he's paying 5 million. But now they have now said, because there is now revised estimates. So what I will now do in that regard is to say 84 million minus how much have we paid? Before now, we have paid this. So that is we have paid 20 million. I'll come here, I remove 20 million.
That was 64.
I'll remove 20 million and I'll divide it by 12 minus how many months have we used before? 4.
Yes.
So this will now be 64 divided by 8. What do I have?
8
million. So from July, July 31st, this guy will be paying 8 million. Remove again. 31st August, 8 million. 30th September, 8 million. 31st October, 8 million. In November again, something happened.
Yes.
In November, the estimates changed. Abi?
Yes, to 90 million.
To 90 million. So I'll say 90 million minus what is the total amount that we have paid? Add all this together. What do you have? 20 plus 32. Abi?
52, yes.
32 million. That will be 52 million. So I will say minus 52 million divided by 12 minus how many months have we done? 1, 2, 3, 4, 5, 6, 7, 8. We have done 8 months. So that will be this minus what do you have?
42.
42.
Oh, 38. 38.
Okay. Are you sure? 38.
Yes, 38.
38 divided by 4. What do you have? What do you have?
9.5.
9.5. So this 9.5 is what this guy will continue to pay for the next 4 months. So this is 30th November 23, 9.5 million. 31st December 23, 9.5 million. The 1st January 2024, 9.5 million. 28th February 2024, 9.5 million. So by the time I add all this together, everything is worth 90 million. Do you understand that? Do you understand that?
Yes.
So it's 90
Yes.
million. Now, this examiner now said, indicate the due dates for the payments. The due date for the payments are these dates that I've written here. These are the due dates for the payments.
Are you all right?
Okay, those are the due dates for the payments. Now, the now say compute the monthly installment payable. This is the installment payable that we have computed. The examiner said, if the final returns, this is where we now have to listen. If the final returns show tax payable of 113.65, determine the 13th installment payable. Now, what I told you the last time is, I said your final assessments which is 113.65 million less your total estimated return, which is 90 million that you have paid. So if I subtract the two, what do I have? So the difference will be 13th installment, which is the final tax liability the company will pay. What is the value?
23.5.
0.65.
So this is a final installment the taxpayer is expected to pay. So that is that. Now, what is the penalty if a company that is supposed to pay this tax liability fail to pay the tax liability? The penalty is that in the first day of default, the guy will pay 10 million naira. First day of default, 10 million naira. And for every of these other subsequent days, in which the failure continues, 2 million. So that means if you're supposed to pay your installments and you fail to pay it, on the first day that it becomes due, 10 million. Every other subsequent days in which the failure continues. So the first installment is due for payment on 31st March. Okay. If you fail to pay this 10 million, if you fail to pay these installments on this day, let's assume you paid it on 1st of April, or you didn't still pay 1st of April. So 1st of April, is 10 million. 2nd of April, 2 million. 3rd of April, 2 million. 4th of April, 2 million. 5th of April, 2 million. 6th of April, 2 million. 1, 2, 3, 4, 5. So let us now assume that you made the payment 7th of April. So your liability penalty is 20 million for failure to pay your returns, to pay your estimated returns to the tax authority. So that is that. Any question?
Okay, no small question, sir. Okay, where the fiscal tax is less than the estimated returns
It is
that
not possible.
I know the government, these guys.
It is not possible.
It's always higher.
It is not possible. Where your estimates? Are you asking where your estimates?
No, I'm asking where the fiscal tax, like the one that government will say the person is liable to, is lower than the estimates the company has paid.
Okay.
You know, if now,
Calm down.
fiscal question is
Calm
lower
down.
than.
Calm down.
All right,
Calm down.
sir.
Okay. So, in terms of pricing of crude sales, what government takes into consideration is the higher of fiscal price or the value of sales. So, assuming you sell your barrel $80 per barrel, and the NUPLC price is $78 per barrel. Government takes $80 per barrel.
So anyhow we look at it, they will win.
Government will win.
It's like casino.
It is $85 per barrel, but you were able to sell your own for $81 per barrel. The $4 on top, you will still pay tax on it. So you are advised to always ensure that you don't sell lower than the fiscal price, and if you sell higher than it, you still pay tax to government on it. It's government's revenue.
So this government is like a casino. They have
Now you know. The government no go chop.
They talk too much now.
Government go chop now. So that is that. Now, examiner could ask you what are the content of estimated returns and actual returns. The contents. You will just tell them for estimated return is similar to that of annual returns. But in this regard, we have computation of estimated adjusted profit. Everything will be estimated. Computation of estimated capital allowance. We get for the period. Schedule showing the qualifying capital expenditure of the company. You will also do estimated total production allowance. You also do estimated tax return for the period. What is the tax return for the period? The estimates. So that is what you usually have in your tax estimates. Meanwhile, your actual estimates, you will have your audited financial statements, which is very important. you would have your computation of adjusted profits, loss relief, and accessible profits. Okay. You also have a schedule showing your total production allowance. You can see that I'm saying the same thing. Your computation of capital allowance. Computation of chargeable profits. Self-assessment form and evidence of tax payable. So that is what that shows. Okay. So that is that. The same thing that you have for your estimates under hydrocarbon tax, you also do the same thing for company income tax. The same procedure. Because in this, you remember I told you at the beginning of the class that it's a dual tax regime where the company income tax and the hydrocarbon tax would be computed. Now, when you are computing your hydrocarbon tax will be computed based on the principle that we have explained before now. When you are computing your company income tax, the same principle that we have explained under company income tax will come into play. However, the only difference here is that for company's income tax, you have to ensure that all the income of the taxpayer that we have said is not going to be taxable under hydrocarbon tax becomes taxable here. In hydrocarbon tax, you remember we said that legal costs is not allowed, bad debt is not allowed, taxes is not allowed, imputed tax is not allowed. We said interest on bank charges, finance charges, all those are not allowed. Meanwhile, under company income tax, all those ones are allowed. So you are still going to allow it here. Meanwhile, you are disallowing it under hydrocarbon tax, but under company's income tax, that you're also going to compute as part of your computation of your tax liability. You are going to what? Recognize those expenses that hydrocarbon tax has disallowed. Do you understand? So that is what we are trying to say. So let's quickly go to the formats. Let's talk about the formats. In my last class with you, I remember we discussed cost profit ratio. We discussed this in my last class with you. And I've told you the essence of this, because the essence of this is to restrict your allowable expenses to a maximum of 65% of your gross revenue. So don't forget. And I discussed all this with you in my last class. So let's put it in that. But let's go ahead, let's see the formats of computation. Okay, computation of tax liability for social year. So I am going to say, look at how straight my hand is. I have not used my hand for batting. Shola cannot say that. So hydrocarbon tax.
I'm drawing when I was in school, so I can draw it.
You cannot draw a straight line, we know.
From here to Lekki, it's very straight.
It's very straight. Okay, well, I've heard you. So let's go ahead. Mr. Wellington, are you following? Mr. Wellington, are you in this class today at all? Alaji, okay, Sede, are you following teacher? Obeyed, you have not been attending classes.
I'm with you, sir.
Okay. Obeyed, you have missed like 3 classes.
I wasn't feeling well, sir.
How are you now?
I'm better.
Well, hope you are watching the video. Just watch the video.
Yes, I'm much. I've downloaded them.
Okay. Omaumi, hope you are together.
Yeah. Yeah, I'm
Good.
here with you.
In your man, we have not seen you in class for some time.
Yes, sir. I'll watch the videos from last
Okay.
week.
All right, no problem. KG, hope you are good.
Yes, thank you, sir.
All right. Ebokun, I greet you specially. Who else? Oruma Ifema, I greet you too. Abiola, I always greet you. All right, let's go ahead. So, in my last class with you, I told you that crude oil sales is taxable. Condensate is a lie. Is taxable. Associated gas is taxable. So these are the only 3 taxable income under hydrocarbon tax. Meanwhile, we still have some other income that are taxable. Non-associated gas is not taxable under hydrocarbon tax, it is taxable under common income tax. Liquefied natural gas, not taxable here, but taxable here. The next one, LPG, not taxable, that is liquefied petroleum gas, not taxable here, taxable here. The next one, we have other income. Not taxable here, taxable here. So you can now see that hydrocarbon tax will not be taxing all our tax. The only one that will be taxing is these 3 that I've mentioned. We'll move on to the next one. So this will be our total income or revenue. We'll move on. Less allowable expenses alone, only allowable. Example of allowable expenses is production and maybe admin expenses. They are liable for both. Exploration costs are liable for both. drilling of first two appraisal wells. You remember they are liable for both. You can also see drilling of first exploration well. It is allowable for both. We move on. Tangible and intangible costs are allowable for both. NDDC is allowable. Royalties allowable. Environmental remediation fund allowable. We move on. Host community development fund is allowable. Is allowable. Cost incurred in acquisition of geological, geochemical, and I think physical is allowed. Let me look at that. Come on. Yeah, geographical. Geographical is allowed. Bad debt is not allowed, is allowed. Bank charges on finance charges not allowed, allowed. Litigation costs not allowed, allowed. You can see as we are taking them one after the other. The next one, interest on borrowing. Not allowed, allowed. Research and development costs, not allowed. Do you understand me? And
Sure.
I have a question, sir.
yes,
Okay, for the bad debts being allowed under CIT, do you mean the specific one, or because I'm a bit confused now? And also for the research and development, I think that's a sunk cost. So why is it not allowed under CIT? I don't know if I'm
why are you
missing things up.
bringing in SFM in tax? Research and
Oh,
development cost is allowed. Do you understand?
yes, sir, I get it now.
At the same time, the bad debt that you're talking about, bad debt generally is allowable. That the one that is not allowable is provision for bad and doubtful debts, where it is now general. We said it's not allowed. With the specific is allowed. So and so on and so forth. So what we are trying to do here is to only bring in the allowable expenses. Okay. Now, I haven't done that. The next one that you're now going to do is to get all your total donation to is allowable on that contract. So after doing all this, the next thing you will do is to get your total cost. Excuse me. So after you've gotten all this will be our total OPEX. Did we include royalty in this? Yes, there's royalty. This will be our total OPEX or operating expenditure. Now, for the purpose of hydrocarbon tax, we need to restrict our OPEX. And that was the essence of the cost profit ratio limits that we talked about last class. So this is not the OPEX that we're going to be taking into consideration. So we need to go and check. So we go and do our cost profit ratio, CPR limit. In this CPR limit, you will take your total revenue you will now restrict it. The maximum expense allowable is maximum expenses allowable is 65% of total revenue. I call it here. They will now compare. So let's call this A. The next one, we need to compute our expenditure, computation of OPEX for CPR limits. So on that OPEX that we calculated the other time, this guy, you will now add, call this one your OPEX. You will add your capital allowance, deduct the following. Pension, contribution to pension fund, deduct it. Deduct royalties, deduct it. Deduct Post Community Development Trust Fund, deduct NDDC, deduct Environmental Remediation Fund, deduct rent of PML or PPL. So the total of this, you deduct from this. You now have your expenses for CPR limits. Call this
Why are
guy.
we deducting?
Call this guy.
Why are we deducting?
That is the act. Call this guy B. So you will now compare A. You compare your A and B. So the maximum you can take is 65% of your revenue. So, and the act also says we compute your expenses that is allowable for CPR. So in doing this, I have done that. So if this one is more than this one, there is no problem. But if this guy is more than this one, so assume this one is $70 million. And this one is $65 million. What I will just take is my $65 million and move ahead. But imagine this guy is 165 million. And when I calculated this, I have 70 million. What will I do? It is the lower of the two, so I have to restrict my allowable expenses to $70 million. A question will now come to you that, Mr. Christopher, what would happen to the balance of the 165? What would happen to the balance of 165? That is 165 million minus 70 million. 5 and 8. Abi, is it 8 or 9?
8.
8, Abi.
Yes, sir.
Are you sure?
Yes. No,
Okay.
No. Not 8. 7 4 9. It's 9.
9. So what will happen to this 95 million? The 95 million will be carried forward to the next year. 95 million. So by next year, when we want to do our CPR ratio, we will say CPR brought forward. Bam, bam, bam. Okay. We will now calculate this guy and this guy again. So if this guy is also more than this guy, you will restrict it to this guy. At every point in time, it must not be more than this. So this balance again will be carried forward. But if, for example, this guy is less, then this balance that you have brought forward, you'll be adding into it. So to get your new CPR ratio, this one that you are bringing forward, this guy, you will add it to this one and calculate the restriction and check. So let's assume in the previous period, you bring 95. You add 95 plus this one and check against this. If it is still more, the balance you carry forward. If it is less, so let's assume what we have here. Let's say this is 20 brought forward. and let's say this is 45. Okay, so if I say, okay, my brought forward plus my current one is 65, it's less than 70, I will take the entire 65. So that is the way it works. So I haven't gotten my CPR ratio, so I will now come here and bring it in. So allowable expenses, allowable expenses as a result of CPR. So what am I bringing in? I am bringing the lower of these two, lower of these two. So I bring it in here. So this is my allowable expenses. Any question?
That will come only under hydrocarbon tax.
Yes.
All right, sir.
So only under hydrocarbon tax. This guy still continues. We don't need, we are not affected. It's not affected. So I haven't done that. You will now deduct your loss relief. The same loss that you're deducting here is what you're deducting here. Loss relief. You now have what we call accessible profits. Okay? Accessible profits. We continue. You bring in your capital allowance. You subtract capital allowance, production allowance. There is no production allowance for hydrocarbon tax. There is no production allowance for hydrocarbon tax. Sorry, for company income tax. There is no production allowance for that. So I will deducted your production allowance. I will deducted your production allowance. They will now have what we call your chargeable profit / total profit. Chargeable profit / total profit. Company income tax usually use total profit. Why hydrocarbon tax usually we call it chargeable profit. Now on that chargeable profit, you calculate your tax liability. On chargeable profit, you use 15%. On total profit, you use 30%. So that is that. Any question? So let's look at the live question.
Sir, please, before you go forward, this 50% is what?
15% is the tax liability for hydrocarbon.
Okay, okay.
Okay. So that is that. If you are there, I am there. So the next one that we need to be looking at now is how do we compose? When is your case study class?
10:30.
10:30. So in our next class, by the grace of God, hopefully I will not be this busy. We'll be looking at 3 questions, and that will be our end of the class on hydrocarbon tax. So let's leave it at this. So we'll be doing like 3 past questions next class, 3 diets minimum. So that is what we are going to start in our next class. Okay? So, good day to you.
Yes, sir.